Hi, I'm Ian Varley, CEO of Eagle Business Credit, and welcome to Eagle Eye. You may be looking for a small business loan for your business. You may have come across the term factoring loans. Let's take a minute and explain what factoring is. Essentially, any company selling to another business that has accounts receivable, they're selling on credit terms, will have a need for funding. Factoring is a way of releasing the cash flow that's tied up in your outstanding receivables. You continue to make sales to your customers in the normal course of event, you issue your invoice, and instead of waiting to get paid by your customer in accordance with your credit terms, a factor will release that cash and give you an advance on your invoices. So it's a revolving form of finance that's particularly linked to your receivables. It's actually not a loan. The factor will be repaid by your customer. So you give the factor your invoice, they advance up to usually 90% of the value of that invoice. The payment then comes to the factor, repays that advance, and you get the 10% or unadvanced portion when the customer pays the factor. The factor will typically take their fee, which is usually a nominal amount, out of the value of the reserve payment or payment from the customer when received. So again, it's an inexpensive form of finance, but it's not a loan. You don't incur debt that you have to make a repayment on as you would with a traditional loan. There's no weekly or monthly amount that's due to the factor. The factor will make advances on all new sales that you make, collect on those invoices, and continue to roll the money for you in that way as you make more sales. So it's a great way of financing not only a growing business, but one where you have a lot of money tied up in outstanding receivables. Again, it's better than a loan because you, the business owner, are not going to make repayments to the factor. Your customer is.